When markets crash, most investors make an emotional decision that destroys their wealth. I just watched a friend make this classic mistake during Trump's recent tariffs announcement. The truth is, history shows today's unprecedented market fears are nothing special. And those who understand this one principle consistently build wealth, while others simply panic and lose. Most investors lose up to half their potential profits because of simple mistakes they don't even realize they're making. Let's try to fix that. The most devastating error happens when emotions take over during market dips. You feel that pit in your stomach watching your portfolio drop, and suddenly selling seems like the only logical choice. But this buy high, sell low pattern is exactly what prevents average people from building serious wealth. And here's what's wild. This pattern repeats during every market crisis, yet we keep falling for it. Beginning investors are especially vulnerable to those wealth-destroying habits. We often believe keeping cash is safer than investing in stocks, a dangerous misconception that guarantees your money loses value to inflation over time. European beginners frequently make the additional mistake of picking individual stocks rather than diversified funds. This approach feels more controlled, but statistically leads to worse outcomes for most people. The research is clear, but contradicts what feels intuitively right, which is why these mistakes persist. Now, investing success requires adopting a completely different mindset than what comes naturally. The stock market isn't a steady escalator moving predictably onwards and upwards again and again. It's more like a roller coaster that generally trends upwards over time. Some years deliver stunning 25% gains. Let's pick last year as example. While others might drop minus 37 or more, and both are completely normal parts of a journey. Now, the investors who build real wealth aren't necessarily smarter, they just train themselves to stay calm during these inevitable drops. They sort of expect them. They understand that today's market panic is just the latest chapter in a story that always ends the same way. The stock market always climbs higher over time, despite the inevitable drops along the way. So ask yourself, are you brave enough to endure the roller coaster for the wealth waiting at the end? If you are, let's discuss a couple strategies I'm following myself, which could help you. First of all, we have to evaluate those long-term fluctuations. Now, S&P 500, top 500 companies in USA. As an example, this is the map of today's date. Let's say take 1 year. 1 year performance and full screen. Now you can see the map and you can see some of the companies doing great, some companies doing bad. For example, Intel is 29% down over the last 12 months. We have Amazon, well, Tesla 60%. Who's more? Who increased even further? Netflix 90% growth, massive. Now you see that a lot of them, we have winners, we have losers, and it's only 12 months. Now if I take a significantly longer period of time, obviously some of these companies drop out of this list, some of them join the list. But if I'm investing in S&P 500, I'm initially saying that I'm investing in top 500 companies now, in top 500 companies tomorrow, and in top 500 companies in 10 years. Now, if I look at a slightly higher horizon, let's take 5 years. Now, does this look like a significant volatility? I mean, roller coaster up and down. Now, we started investing straight away and increased by 50%, massive growth. But then in 2022, which hasn't had any specific crisis, to be honest, we had nearly 25% drop at certain point from highest point to the lowest point. In here, we had the tariff situation where initially Trump explained that it will attack the rest of the world, and we suddenly had 17% drop. Since then, we still had the increase back. Now, this is last 5 years. If I look back over a significant amount of time, you can't even see those little drops here. Now, of course, 2020, we have pandemic. This is like 30% from highest point to the lowest point. 2008, we have property crisis. 2000, we have a big dot-com bubble, another 50% drop. But if I look over time, 700% from 1996. Initially, the idea is quite simple. It's to understand that if I'm investing in S&P 500, I'm investing in a fund which tracks the top 500 companies and rebalance the portfolio based on the company sizes. So the bigger company, the more successful company, the more money of my investment goes towards that company. And how I do that in practice, I simply follow a very simple ETF. It's this exchange traded fund, which is VUAA, so Vanguard company. And if I search for VUAA, you can see Vanguard S&P 500, one of the cheapest versions, ticker symbol VUAA, ISIN code if you need to find it on your brokerage system. And if I open the fact sheet, it has a lot more information, basically the historical returns, which I would expect close to 10%, and also all of the information of like top 10 holdings, where you're investing, which sectors. Obviously, top 500 companies in USA is 100% USA companies. What I'm doing with that, I simply invest in one specific position. I would change euros to dollars and buy a unit and do this again and again and again and again. And you can see that I don't spend too much time. It cost me around €2 to buy it, and I simply invested every month since 2022 September. Now soon is going to be 3 years, and my portfolio gives me quite decent results. This experiment was created with the idea to show you that investing is quite simple. Of course, I have other strategies as well. I'm not just investing in here, and it's not all my assets. But so I've got tired with the idea that everyone keeps telling me that you have to invest thousands and thousands to actually see results. Well, here's the example where I'm investing €100 a month, and the results sort of speak for themselves. Fun fact, you can actually track this portfolio. All the links obviously in the description, and you do have to register with this broker for you to have an access to follow this portfolio. And if you don't, again, I'm investing in the same thing each month, so I'll be doing the updates every few months just to show you how the portfolio is doing. Of course, I'm expecting ups and downs, and that is part of the journey. If you can plan your first crisis and what you're going to do through that, like remain in the market, invest additionally if possible, I think if you have that plan and you expect the crisis, it will be easier. If you don't, it might destroy your portfolio. So be careful. And if you do have any questions, feel free to drop them in the comments. I will respond to all of them, and I'll see you in the next episode. Hope this helped.